Here's a number that breaks most people's mental model of money completely. In most modern economies, somewhere around 95 to 97% of the money in circulation was never printed, minted, or created by a government at all. It wasn't made by a central bank running a printing press. It wasn't authorized by an act of Parliament or Congress. It was created quietly the moment someone signed a loan agreement at a commercial bank. That sentence tends to sound like a conspiracy theory the first time you hear it. It isn't. It's mainstream economics, confirmed in plain language by central banks themselves, including the Bank of England, which published a paper explicitly correcting the public's misunderstanding of this exact process. So if banks, ordinary, private, profit-seeking banks, are the ones actually creating most of the money you use every day, who's really in charge of the money supply? And why does almost nobody understand how it actually works? That's what we're unpacking today. The myth you were taught in school. Most of us grew up with a simple, intuitive story about how banking works. It goes something like this. People deposit their savings into a bank. The bank keeps most of that money safely in a vault. Then it lends out a small portion of it to other customers, keeping a reserve behind just in case. This is usually called the fractional reserve model, and it's taught in introductory economics courses around the world. It's tidy, it's intuitive, and it's largely backwards. In 2014, the Bank of England published a research bulletin bluntly titled Money Creation in the Modern Economy, directly stating that this textbook description does not reflect how banking actually works in practice. Instead, the reality runs the opposite direction. Banks don't lend out existing deposits. Banks create new deposits by making loans. Let that sit for a second because it inverts the entire intuitive story. It's not deposits first, then loans. It's loans first, and the act of making the loan is what creates the deposit. This isn't a fringe claim. It's now the standard explanation given by major central banks, including the Bank of England, the Bundesbank, and the Federal Reserve in various educational materials. And yet, this remains one of the most widely misunderstood facts about the economy most people participate in every day. How a loan becomes money out of thin air. So how does this actually happen, mechanically? Imagine you walk into a bank and get approved for a $20,000 loan to buy a car. In the old textbook story, the bank would need to already have $20,000 of someone else's deposits sitting around, ready to hand to you. In reality, here's what happens. The bank simply creates a new deposit of $20,000 in your account and simultaneously records a $20,000 loan asset on its own books. No cash moves. No vault opens. Two numbers appear in a ledger at the same instant. One saying, "This bank owes this customer $20,000," and one saying, "This customer owes this bank $20,000 plus interest." That deposit, the $20,000 now sitting in your account, is money. You can spend it, transfer it, or withdraw it as cash. It functions exactly like any other dollar in the economy. But a moment ago, it didn't exist. The bank didn't take it from another customer's account. It manufactured it, digitally, as a byproduct of extending credit. This is why economists describe the vast majority of the money supply as broad money, as opposed to the physical cash and central bank reserves that make up what's called the monetary base. Broad money, the number that actually represents how much money is circulating through the economy, is overwhelmingly made up of these bank-created deposits, not physical currency. Multiply this single car loan by every mortgage, every business loan, every line of credit issued across the entire banking system, continuously, every single day. and you start to see where the overwhelming majority of the money supply actually comes from. Then, what does the central bank actually do? If commercial banks are creating most of the money, what's left for the central bank to do? This is where people often get confused, because the popular image of a central bank printing money doesn't match its actual daily function. Central banks, the Federal Reserve, the European Central Bank, the Bank of England, and others, create the monetary base, physical currency, and the electronic reserves that commercial banks hold in accounts at the central bank itself. This is the foundation the rest of the system is built on, but it's a relatively small slice of the total money supply. What central banks actually spend most of their time doing is something more like steering the money creation process that commercial banks carry out, rather than doing that creation themselves. They do this primarily through interest rates. When a central bank raises the rate it charges banks to borrow reserves, borrowing becomes more expensive throughout the economy. Loans slow down, and, because loans are what create deposits, the overall pace of money creation slows too. Lower the rate, and the opposite tends to happen. Central banks also set reserve and capital requirements, rules dictating how much capital or reserves a bank must hold relative to its lending. These don't function quite like the fractional reserve story suggests either. In several major economies, including the US as of recent years, reserve requirements have actually been reduced to zero for many institutions, with capital and liquidity rules doing more of the regulatory work instead. And in extraordinary circumstances, central banks step in directly, through tools like quantitative easing, where the central bank creates new reserves to purchase assets like government bonds, injecting money directly into the financial system when normal interest rate tools aren't enough, as happened extensively after the 2008 financial crisis and again during the COVID-19 pandemic. So the honest answer is, central banks set the rules of the game and hold the largest lever, interest rates. But the actual day-to-day creation of the money you spend happens inside thousands of individual commercial banks, one loan at a time. The limits. Why banks can't create infinite money? If banks can create money by simply issuing loans, what stops them from doing it endlessly? The first constraint is profitability and risk. Every loan a bank creates is also a bet that the borrower will pay it back with interest. Banks don't create money for its own sake. They create it because lending is their core business, and bad loans threaten their solvency. A bank that creates too much money by lending recklessly ends up holding a portfolio of loans that may not get repaid, which is precisely what happened to many institutions during the 2008 financial crisis. The second constraint is capital requirements. Regulators require banks to hold a certain amount of their own capital, essentially a financial cushion, relative to the loans on their books. This doesn't stop money creation directly, but it limits how much lending, and therefore how much money creation, a bank can responsibly take on before running into regulatory limits. The third constraint is demand itself. Banks can't force people to take out loans. Money creation through lending only happens when businesses and households actually want to borrow for a mortgage, a car, a business expansion, and are judged creditworthy enough to receive that loan. In periods when confidence is low and few people or businesses want to borrow, the money creation engine can slow dramatically, even if interest rates are low, which is part of what made recovery from the 2008 crisis and various periods of economic stagnation so difficult in several economies. Finally, there's the constraint of interbank settlement, when one bank's customer sends money to a customer at a different bank. The two banks need to settle that transfer using central bank reserves. If a bank creates money faster than it can maintain enough reserves to settle its obligations with other banks, it runs into serious liquidity problems, which is exactly the kind of stress event central banks are designed to monitor and, if necessary, intervene in. So money creation isn't infinite or arbitrary. It's bounded by risk, regulation, demand, and the plumbing of the banking system itself. But within those bounds, it happens on a scale that dwarfs the physical currency most people picture when they think of money. Why this surprises almost everyone. So why is this one of the least understood facts about the modern economy, despite being confirmed openly by the very institutions that manage it? Part of it is simply that the intuitive storage model of money, that a bank is just a vault holding your savings, maps neatly onto our everyday experience. You put money in, you take money out. It feels like storage, even though the underlying mechanics work completely differently. Part of it is that the language used in economics education has been slow to catch up with how central banks themselves now describe the system. Many textbooks still teach the old fractional reserve deposit multiplier model as though it's the primary mechanism, even after major central banks have published research explicitly correcting that framing. And part of it is that the reality is, frankly, a little uncomfortable. It means that a huge amount of the money circulating through the economy exists because private, profit-driven institutions decided to extend credit, not because a democratically accountable government decided how much money the economy needed. That single fact has fueled entire schools of economic thought, serious policy debates about how tightly banks should be regulated, and no shortage of overheated conspiracy theories that go well beyond what the actual mechanics support. The truth doesn't require conspiracy to be striking. It's genuinely surprising enough on its own. Most of the money you'll ever use in your life will be created not by a government, not by a printing press, but by a private bank deciding to say yes to a loan application. What this means for the economy you live in. This isn't just an academic curiosity. It explains a lot about how the economy actually behaves. It's part of why credit booms and housing bubbles can inflate so quickly. When banks feel confident and eager to lend, they're not just distributing existing money faster, they're actively creating new money, which can pump up asset prices in a self-reinforcing cycle. And it's part of why credit crunches can be so damaging. When banks pull back on lending out of fear, they're not just being cautious. They're actually shrinking the money supply, which can turn a slowdown into a much deeper downturn. It also reframes what interest rate decisions really do. When a central bank changes rates, it's not just changing the cost of money. It's adjusting the incentive structure that determines how much new money gets created across the entire banking system in the months that follow. Understanding this doesn't require becoming an economist, but it does change how you interpret headlines about interest rate decisions, lending standards, and financial stability. Because underneath all of it is this same basic mechanism running quietly, loan by loan, every single day. Final thought. Money can feel like one of the most solid, unquestionable things in modern life. A fixed, physical fact of the world, sitting in vaults, printed and counted and locked away. The truth is stranger and, in some ways, more human than that. Most of it doesn't exist until someone decides to trust someone else enough to lend to them. It's created in that moment of trust, multiplied across millions of decisions made every day inside ordinary banks, and it vanishes again, just as quietly, whenever a loan is repaid. Money, it turns out, isn't just something we store. It's something we constantly, collectively create. If this changed how you think about that number in your bank account, that's exactly the kind of thing this channel exists to explore. The everyday systems that shape our lives, hiding in plain sight, right under the surface of things we assume we already understand. Let me know in the comments. Should we go deeper next into how quantitative easing actually works, or how the 2008 financial crisis reveals the dark side of this exact process? See you in the next one.